This evening, stocks are bouncing back after yesterday's major sell-off. S&P 500 is 3,277 points down. On the other side, almost 0.8% in the green, and Nasdaq Composite 1.30 in the green territory. The VIX index slightly higher once again at the 16.18 mark. I want to show you very quickly the bond market. We have slightly lower treasury yields. Once again, the 10-year yielding 1.6, the 2-year 1.4, and the 3-month 1.5. On the other side, in terms of Forex, the dollar index inching higher and higher. Have a look at it, 0.1%, but above the 98 mark, and that was very, very expected. Euro dollar on the other side, 1.10, slightly lower by 0.04%, and the sterling against the dollar, 1.30. We're going to be back on the markets, but let's get straight to the major headlines. Stocks raising following the market's biggest sell-off in more than 3 months as investors grapple with lingering fears over possible coronavirus outbreak. The UK government gives the green light to Huawei to build part of its next-generation 5G network, dismissing calls from the Trump administration to boycott the Chinese telecom giant. Airbus has reached a preliminary agreement with fraud agencies in the US, UK and France over the probe into bribery and corruption. Business software maker SAP raised its earnings outlook as strong growth in cloud-based software drove a 22% increase in fourth quarter profit. Apple set to report Q4 and full-year earnings after the bell wearables and services, the two departments to watch. We're certainly gonna discuss each and every one of the topics, but I want to start with what's going on in the United Kingdom, because certainly this is going to be very important and probably a reason for further clashes between the UK and the US from trade point of view. Actually, the UK government gives the green light to Huawei Technologies to build part of its next generation 5G cellular network, dismissing calls from the Trump administration to boycott the Chinese telecom equipment vendor over security fears. The government said Huawei would be given permission to build non-critical parts of the country's 5G network. Britain's National Security Council concluded that the security risks the Chinese company presented could be managed. Huawei officials have repeatedly denied claims that its equipment could be used by the Chinese state to spy on countries or incapacitate key infrastructure. The decision is a major setback for American-led efforts to clamp down on the use of Huawei products and could embolden other countries to follow the UK's lead. That's for sure might be a major hurdle. On the other side, I want to stay in terms of regulation, so I have to talk about Airbus, because we did hear a pretty positive story this evening. Actually, Airbus reached a preliminary agreement with fraud agencies in the US, UK and France over their probe into bribery and corruption, lifting a reputational and legal cloud that has hung over the company for years. The European plane maker had reached in principle a so-called deferred prosecution agreement that allows the company to avoid formal charges and requires it to pay what is expected to be a record fine. The agreement still requires approval by courts in each jurisdiction. The settlement comes about 4 years after Airbus first announced it was under investigation for using third-party consultants to help secure lucrative orders for commercial aircraft. Airbus said at the time it has self-reported to investigators after discovering irregularities in its submissions for state-backed funding guarantees. Certainly, this is an extremely interesting story. Once again, positive news for Airbus, especially after the fact that the US peer Boeing is suffering in the last few days. In order to comment all these major stories, let me bring to the show my next guest this evening, Andrea Di Gaetano, financial analyst. Good evening, Andrea, and thank you so much for joining us.
Thank you to you. Good evening.
Andrea, I want to start with the markets. We do see a major bounce back to higher levels. S&P 500 is 3,276 points, so pretty close to the 333 level that we saw a few days ago. On the other side, I wanted to remind everyone that also European stocks traded higher today. The Stoxx 600 closed 0.9% higher, and FTSE MIP in particular outpaced its European peers. And I wanted to remind the coronavirus updates. Outbreak has killed 106 people so far and infected nearly 4,700. So the preoccupation remains, but we do see a positive trading. Why is that in your opinion, Andrea?
So we had a positive news flow coming from Global Times, and according to Global Times, China is likely to have a vaccine for coronavirus. So this is a positive news. And there are other technical reasons. For example, the S&P and also important stocks as the important support levels. For example, S&P 500 is 3,220. For important tech stock like Apple, we have the Apple going down to 305, and then bouncing back after a better news flows and expecting earning report after market close, and I think that the market is having a breather, a pause in this sell-off that we have seen in the last hours, and I think that it is too early to understand if the market will continue to rise or it is just a bounce and then we will see a new correction.
That's very interesting. And talking about earnings, certainly Apple is going to report after the bell, but I want to start with the software giant, an European stocks, which is SAP. As we can see, it closed down by 2.14%, the European trading session. And let me just bring you some details to all our viewers. The business software maker SAP raised its earnings outlook as strong growth in cloud-based software drove a 22% increase in fourth quarter profit, beating analyst estimates. The solid result capped a tumultuous year for one of Europe's most valuable technology companies as it shifts customers away from on-site businesses software toward cloud-based solutions, facing, of course, stiff competition from Amazon, Alphabet, Google, and Microsoft, and of course many others. SAP launched a restructuring effort a year ago, shedding 4,400 jobs and costing an estimated 800 million euros to 950 million euros. SAP net profit rose to 2.18 billion in the 3 months to December 31st from 1.79 billion, encouraged by a 32% increase in cloud revenue in the fourth quarter. SAP lifted its sales outlook for 2020 around 2% to as much as $29.7 billion. Despite this fact, we saw the software company closing lower by 2%. So talking about technology giants, we do see also positive performance for the fourth quarter from some European technology giants. But let's focus for a second on Apple, because certainly it's one of the major technological companies, not only in the US but worldwide. First of all, what do you expect as earnings for the Q4 from Apple?
Yes, we have a good expectation for Apple. The earning per share is expected at $4.54 per share, so it is even better than the last quarter. I think that, for example, another news coming is that Apple plans to boost production by 10% in order to provide iPhones, and as the company has received a lot of orders on iPhones, so we see a very good performance in Apple, and Apple is one of the leading stock of the rally we have seen, and he's outperformed in the S&P 500, and during last year Apple has risen about 86%, so a lot. So I think that a lot is discounted in the actual prices, but if the earnings are beat the estimates, I think we could have a new high, marginal high, at around 330, which is the most important 330, 340 resistance level. On the contrary, if the earnings are below the expectation, we could see a new base option below 300 with a target at 280.
There are a few different facts regarding Apple that I want to remind our viewers. For instance, Apple's market cap briefly exceeded $1.4 trillion last Wednesday for the first time, but of course it has yet to end the session at that level. Apple never ended the session at that level, but still on Wednesday we saw exceeding $1.4 trillion of market cap, which is remarkable. And I wanted to remind everyone in this occasion that we're talking about the earnings season of Apple, that in the last year, in 2019, it shifted from software company to wearables and services. Because of course it has its own Apple service, streaming service. I don't know if you're subscribed. Are you subscribed?
So we have seen last quarter services revenue reaches all-time high at 2.5 billion, and Apple is switching from selling iPhone, and which is the core business, to providing more services, cloud services, streaming services, and perhaps this could be the new driver for the company. We will see after the year. The iPhone still performing very well, even though are towards a lack of innovation in the rate of iPhone. So this perhaps could be a point of weakness. We'll see after the market, the report release after the market close.
I want to get back to the major U.S. indices. For instance, today we saw a little bit of positive macro data coming from the United States. The U.S. consumer confidence jumped in January to 131.6 versus 128 expected, so above expectations, which is something pretty positive. So at this point, we saw also markets bouncing back to their almost hovering around their all-time record highs. So I was wondering, in your opinion, do you think the coronavirus fears are all overblown?
No, I think that so we have seen the first phase of panic, where the investors are trying to understand how fast the coronavirus could affect the economy. What, for example, we have seen, we can compare what happened in 2003 with SARS, and we have seen that SARS had, for example, incubation period which was faster, and so I think that it is perhaps too early to understand the effect, and in the past we have seen this kind of these have affected the economy and the market more seriously. So if we consider the past, we could expect new volatility on the markets, and I think that perhaps, for example, also on this issue on new order and new production on iPhones, we know that the production is in China, for example, and cluster effect by this kind of disease, and all the production of iPhone could have could arrive late regarding the plans of Apple, and this because of for example, a stop or on communication, stop on travels, and I think that it is very early to judge and to have an idea. I would expect more volatility in the coming weeks.
Exactly. We also witness higher volatility. Do you think this level so far right now at the 16 mark, but yesterday it hit the 18 mark for a very short time. Do you think this is a good level and of course good moment for investors to enter the market?
So no, I think that it is a good. Today we have had some point of support in the market, and so it is normal to see a rebound. I would wait a more deeper correction before buying again.
All right, thank you very much, Andrea Di Gaetano, financial analyst. Thank you so much for joining us, and have a great evening.
You too. Thank you very much.
Well, I just wanted to remind everyone that today kicked off the FOMC meeting, and certainly we're going to discuss which are the most likely scenarios during tomorrow's meeting, and of course following press conference that we're going to follow live as always. So stick around. We're heading for a very short commercial break, but we're going to be back very soon. Good evening, everybody, and welcome back to Lefone International. As we can see, market jitters are fading away. S&P 500 1% higher this evening, 3,277 points. Dow on the other side as well, 0.8% higher, and Nasdaq Composite 1.32% in the green territory. The VIX index also slightly higher at the 16 mark. And I want to switch very quickly to the fixed income. The US 10-year Treasury is yielding 1.6, the 2-year 1.4, and the 3-month 1.5%. I want to talk about the United Kingdom and the European Union, because the relationship between the two countries, especially after the Brexit, which is going to happen 31st of January, are going to be very complicated, or at least it looks like, because the European Union will never compromise on the integrity of the bloc single market when it comes to negotiating a trade deal with the UK, according to the EU's chief Brexit negotiator, Michel Barnier. There will be no compromise on the single market, never, Barnier said at Queen's University Belfast on Monday evening. It's our main asset on the EU side. He said, never will the EU compromise or make fragile or unravel the single market. The EU single market seeks to guarantee the free movement of goods, capital, services, and labor, the four freedoms within the EU, with a collective population of over 500 million people and consumers. The value of single market membership and the unfettered movement of goods and services is a boon to businesses in the bloc. When the UK leaves the EU on Friday, January 31st, it will remain a member of the single market, but only during a transition period until the end of 2020. So we're certainly going to follow the events. I want to show you also the major currencies. Sterling against the dollar slightly lower by 0.5%, 1.2999. And of course, UK certainly is going to be under pressure, because today the UK government gives the green line to Huawei Technologies to build part of its next generation 5G network. And this is going to be something that will not make happy the US, no doubt about it. We're going to discuss this a little bit later. I want to show you very quickly a particular stock, since we're right in the middle of the earnings season, and this is the 3M company. Have a look at it, sinking by more than 5%. 3M reported falling revenue in the US and some other top markets, and set plans for a second round of layoffs in less than a year. The maker of everything from post-it notes to industrial sandpaper reported a fourth quarter revenue decline of 2.6% when excluding currency movements and acquisitions, including a 2.9% drop in the US. 3M said it was eliminating 1,500 jobs as part of a broad restructuring to streamline its global operations. 3M employs 96,000 people so far. We continue to face growth challenges, Chief Executive Mike Roman told analysts on a call earlier today. We're going to comment what does it mean for the U.S. economy, but let me first bring to the show my next guest this evening, Jean Ergas, Tigris Financial Partners. Good evening, Jean, and thank you for joining us.
Thank you, Alexandra. Always a very great pleasure. Always a very great honor to be here. Thank you.
And Michael Roche, Fixed Income Strategy, Seaport Global. Good evening, Mike, and thank you for joining us.
My pleasure, Alex. Good evening.
Jean, I want to start with you and the current market's performance. It looks like the market jitters is definitely fading away, despite the fact that the coronavirus outbreak is not limited at all. Actually, it's getting more viral and viral.
Sure. Well, I don't think the market jitters are over at all, quite frankly. I think what we're actually seeing is one market, which is the U.S. market, which has decided, maybe in its wisdom or not, that A, the U.S. is isolated. I mean, B, the problem is not a problem in the U.S. C, I mean, we're seeing improved consumer sentiment in the U.S. because, as we always say, in fact, in the U.S., we talk global and we act domestic. What really counts at the end is the performance of the U.S. consumer, how solid is the domestic economy, and that still seems to be somewhat holding. So I think that's what's really going on in the States right now. I think if you look at other markets, and it's not as rosy, and certainly what we call the full contact indicators, which are the real on-the-ground indicators, uninfluenced generally by monetary policy or short-term, let us put it this way, skullduggery one way or the other, such as oil. Oil is certainly not brilliant. Treasury rates, 10-year yield on the Treasury bond is not exactly reflecting boom times. And gold is still very well perched. So I think that there's two split here we're going to be seeing. There's a split between the stock market and, let us put it this way, the full contact real world indicators. And I think what's happening in the US today is a momentary day off. Any amount of news can arrive. The WHO can upgrade this crisis from a national to a global. And quite frankly, anybody who's trying to model what is actually happening in China, I think, is completely wasting their time. This is not a place where you're going to apply incremental analysis a la Economics 101, which I teach, mind you, in several universities. This is not going to work. This reminds me much more of when I was in the risk management insurance business, and we were looking at catastrophe risk, we were looking at fire risk, and the first thing they told us was, you know what, this is binary. This is a total loss. Anybody who thinks that they can actually extrapolate this, I think, is kidding themselves. Here, it's very simple. Full contact, real world indicators are pricing to the tail. Whilst, in fact, let us put it this way, the stock market is still insisting on a more normal distribution of events, which I think is unrealistic, quite frankly.
I want to switch to the fixed income board because we observed very interesting movements in the last few days. The US 10-year Treasury is yielding 1.6, the 2-year 1.4, and the 3-month 1.5. Mike, what is signaling the bond market?
Well, clearly the market's anticipating some type of drop in activity emanating from China, for example. Just recently, or in fact this morning, out of the South China Morning Post, a private sector firm did take a stab at Q1 Chinese growth, looked at it as down 4% quarter on quarter, and that with the oil market falling as well, with the combination of tepid demand and continued excess supply, price pressures are fairly muted. And so some of the indicators that I watch, such as the 3-month T-bill rate to the 2-year Treasury note rate, continues to go further negative. We're now at negative 9 basis points. The last time on my show the other week, we were at negative 4. And so that's showing a fairly benign inflation perspective by the market. In addition, there's in the backdrop of the Fed and policymakers standing ready to provide liquidity in the event of some shock remains ever present.
Mike, I wanted to show you very quickly the Italian 10-year BDP yielding 1.030, and the spread between the 10-year BDP and the 10-year Bund is 137 basis points so far. You've been always pretty bullish on Italian BTPs, that's for sure. But after the regional elections, I don't know if you're following the political situation in Italy, the major gainer in Italy was not the equity market, but exactly the bond market. Do you find it attractive at this point, yielding 1.03? And do you find it, how can I say, as a good investment solution?
Well, at this point, Alex, what's interesting in the European bond market, I find, is that the presence of negative yields, and as a starting point now, given, let's say, we'll have a more range-bound trading environment during the course of this year, will make it difficult for the German, Dutch, and Austrian parts of the European bond market to actually post a positive return. If anything, the yields could rise. So I suspect that Italy, with the center prevailing in the center, or the favored party in the regional elections prevailing, that the Italian debt looks more attractive on a spread basis against Germany than, say, an outright basis for capital gain. So I suggest, a more like the other bond markets when we spoke about this at the beginning of the year, we'll have a much more lower total rate of return for 2020, and Italy is no exception.
Certainly, I mean, that's very interesting point. John, I want to get back to the U.S. markets for a second. For instance, today we saw the U.S. consumer confidence, which jumped in January to 131.6 versus 128 expectations, which was above expectations once again. But on the other side, we saw such a major and significant giant for the U.S. Manufacturing sector, the 3M company, which is sinking so far by more than 5%, reporting negative earnings. Are you preoccupied regarding the manufacturing sector, or you don't think there is a space for preoccupation?
No, I think I am worried about the manufacturing sector, as we've always held to our line, which is that the U.S. economy may be moving, it may be moving better in some, but it's running on one leg. Now, eventually that one leg, however strong it may be, will start to get very tired, and the U.S. economy will hit a speed bump or fall down. So I think I am concerned. I think what the markets are looking at, though, is something different. I mean, from my concerns, the market's concerns is somewhat different. The market looks at the labor market. The market looks at the absorption of previously marginal, let us put it this way, endless supply of labor on the sidelines now being absorbed into the mainstream. Sees a group of new consumers. How long this will last, nobody knows. Nobody knows this is simply a cyclical late expansion stage phase or phenomenon or something structural. So look, these people are out there, they're buying, they're feeling good, they've got a job, they've got a better job. So yes, I mean, short term, I think the consumers can keep pulling us through. Longer term, we have an issue with manufacturing, and I do not believe that the two are separated by hermetic compartments, and eventually you will pass through. There can also be companies that have been having issues of their own, which are idiosyncratic, specific to themselves, and are then once again caught up, let us say, in a slowing manufacturing cycle. But I think basically it is a problem, and I think capital investment is a problem. Maybe you have to split the two, the manufacturing for export, and we have to look at how much U.S. companies are actually investing in capital, because that, in the end, in the longer run, true, we will all be dead, but it is still important, is actually what's going to boost productivity and low inflation growth. So I think this, it is an issue, but I think the market is taking a here and now, we're on the dance floor, let's go with it, go with the flow. We have to see how long this lasts. I think the central banks will continue to be accommodative. I don't believe the central banks can solve all problems, and I certainly do not believe any central bank intervention can solve a major panic on an existential issue of of this coronavirus epidemic. Because I think that is a point I feel very strongly about. We are trying to model something on the basis of economics and finance, which is not modelable. So I think markets need to take care of this and need to think it out very carefully.
I want to talk about a Federal Reserve because today the FOMC kicked off their meeting, and tomorrow is going to be the press conference, the following press conference, and of course the monetary policy decision. Of course, nobody expects any rate cut or rate hike, but many investors are certainly expecting any hints in terms of balance sheets. Michael, we've been talking a lot about a Federal Reserve, especially successfully flooded markets with cash late last year to avoid a spike in overnight lending rates, the so-called repo rates. So people want to know how and when they're gonna wind down this program. Do you think, first of all, they're gonna stop this program any soon? And secondly, do you think we're gonna, have some more information regarding this topic tomorrow?
Sure, Alex. Well, I think that the open market operations are here to stay, even as just a precautionary act. In that the pressures in the funding market during the last quarter of 2019 caught the Federal Reserve by surprise, and so there is a framework has been constructed for the temporary injection of reserves into the banking system, the so-called repo operations, and I'll just see them adding that to their toolkit in an effort to keep stable the short-term funding markets. And to that end, tomorrow there may be some sort of a housekeeping decisions taken in that end. there may be a change on the interest paid on overnight excess reserves, for instance. Not a major issue, but as you were saying, to leave rates alone. I don't think there'll be any startling change with respect to balance sheet balance sheet policy and the repo policy. If anything, the news that's caught some attention is the a fairly large jump in the number of voting members of the Federal Reserve Committee that have signaled a move of U.S. inflation above the Fed's 2% target range after over the next 3 years. So there's somewhat of a benign approach to probably the most hidden risk, which would be the resurgence of inflationary pressures, and that's just about it. And here we sit, and so we'll just not really expecting much in the way of any earth-shattering news tomorrow.
Jean, on the other side, how does the Fed feels about inflation, which is, their major headache so far?
Well, I think the question of inflation is extremely complex. Let's say previous generations, I'm 64, so many of us have seen a number of this. Previous generations saw inflation basically resolved by cyclicality. As the economy picked up, there was growing pressure on resources, wages rose, input prices rose, and prices, and that was basically it. The CPI sort of elevated itself, and yet solved the problem of deflation. What we're actually seeing now, in fact, is more than cyclical deflation, a cyclical factor. We're seeing structural factors, longer term, which are going to be intrinsic to the system, which are going to keep price increases modest or practically nil. So I think this is really the problem for the Federal Reserve. The Federal Reserve must say to itself, look, this keeping interest rates low to boost inflation, is it actually going to work in a context, for example, in which inflation is simply structural and technological improvements or reduction of layers, for example, in the value chain and revenue chain are lowering costs? So I think it's going to be a major problem for them, quite frankly. I think a major problem for the U.S. economy. But let us get it straight. There are a lot of small and medium-sized firms that need inflation to survive and have posited their borrowing to invest in capital equipment and capital assets on being able to subsequently price inflation plus and generate the sufficient cash flow to repay their debt. So I think down the road, if we continue to have a very low inflation environment, a very modest pricing power environment, we could even start seeing more insolvencies. I think it is a problem, and I think they're going to have to take a position on it, and they may even start thinking of basically revising their inflation target. I don't know if they're going to go that far or not, but certainly it is an issue, and is a very key issue for the U.S. economy and other economies as well, which let us put it this way, from 1945 onwards to a minor or major degree relied on inflation to create wealth via asset revaluation and therefore boost consumption, and also to enhance the pricing power of companies, increase profitability, and reduce dependence on lending or loans, bank lending, to actually steam forward and create jobs. So this is very important. I think they are going to mention it, and they may be slightly more muted in their optimism as to reaching this target in the short term.
Mike, I was wondering, do you believe the coronavirus is going to be one of the new concerns for the Federal Reserve, because they have always been talking about a trade war between the U.S. and China, and that they have been following the events very closely together with the Brexit, which is coming very, very soon. So do you think the coronavirus might be, how can I say, another major concern, or because actually the market jitters that we saw yesterday, the major sell-off that literally caused all the major averages to erase all earnings for 2020 and a major decline of treasury yields, was exactly the coronavirus?
Yeah, indeed. Well, to me, the coronavirus is a phenomenon that is outside the scope of monetary policy in its first instance, to the extent that it has a pronounced and more than short-term impact on demand, aggregate demand, for example, or trade volumes and flows. They may attempt to respond to that, but dare say it's not a direct relationship. It's a similar, not too dissimilar from other supply kind of, I would liken it to a supply shock where when you had the price of oil in the past leaping forward, or in fact or crashing off, there was the interest rate policy is a poor mechanism to try to offset those particular phenomenons. So I look at it as something that it will be monitored quite closely, but not actually built into one of the criteria for the conduct of for the policy decisions taken by the Fed.
I wanted to bring you breaking news. The U.S. budget deficit likely will break the $1 trillion barrier in 2020, the first time that has happened since 2012, according to Congressional Budget Office estimates released right now, like a few seconds ago. Mike, is this a concern in your opinion?
Well, I've been in the financial market since the early '80s, and periodically there's always a concern about the degree of the budget deficit and the ability of the Treasury to finance its position and what have you. And it's always been seen off. It's never been really a cause for catastrophe. And in this particular instance, I suppose it's occurring in the context of other industrial world nations looking to, or benignly or by an engineered manner, keeping deficit spending and the like well beyond what one had thought was to be possible, whether as a percentage of GDP or just in outright terms in decades past. So there seems to be plenty of liquidity in terms of the amount of investable funds. If anything, right now has an excess position over the supply of financial assets. So I don't look at it as being causing a challenge at this time, Alex.
Jean, what's your take instead?
My take is very different. I mean, sort of on this whole issue. I mean, if we're looking at sort of the U.S., if we're looking at specific issues, I would say that basically, we are going to steam along here. I think this is basically going to be it. I think the issue of the coronavirus, like Michael was saying, is definitely non-accessible. I think the time being, some have actually managed to put this aside. I do not believe that this is going to last for very long. I think there are moments when the Fed focuses on, let's put it this way, specific non-monetary issues. The Fed tends to look at these as short-term phenomena. Let us remember that the Federal Reserve's mandate is not to manage an economy on a short-term basis, but to try to plan for the medium term. So I think this is really the issue. Are we going to start seeing a Fed which is going to start focusing, for example, on these jolts, on these sudden exogenous shocks, or are we going to see a Fed which is going to continue to focus on, let us put its long-term mandate? I think what's really about, I think they're going to continue to say, you know what, these are short-term things that we are looking at now, the trade, the coronavirus. Let us see how this plays out. We are focused internally. I think this is very much of a Monroe Doctrine Federal Reserve, which says America to the Americans. This is our bailiwick, and this is what we're going to posit our actions on.
All right. Thank you very much, gentlemen. Jean Ergas, Chief Economist, Tigris Financial Partners.
Thank you very much indeed. It was a great pleasure also being with Michael Roche. Great honor, great pleasure. Thank you.
And Michael Roche, Fixed Income Strategy, Seaport Global. Thank you, Mike, once again.
Thank you very much, Alex. Thank you, John. Very instructive. Appreciate your time.
Absolutely.
Well, guys,
thank you very much indeed.
Well, that was the last story for this evening. Thanks so much for watching, and see you tomorrow exactly 6:45 p.m. on Lefante TV. Stick around.